Every year, the stock market drops 5% or more. And every year, millions of investors make the same costly mistake: they panic and sell. They don't rebalance. They don't adjust. They hit the sell button, lock in their losses, and then watch from the sidelines as the market recovers without them. A long-term study found the average retail investor earned just 2.9% per year, while the broader market returned over 10%. Think about that. The gap wasn't caused by bad investments. It was caused by bad reactions. Fear. Panic. Emotion. Meanwhile, another group of investors watches the exact same market crash and barely reacts at all. The market drops 20%. They don't call a financial advisor. They don't spend hours scrolling through social media. They simply continue with their lives. So what's their secret? It's not intelligence. It's not luck. And it's not some magical investing strategy. It's a number. A specific financial threshold where the math finally starts working for your peace of mind instead of against it. Most people have heard of the famous 4% retirement rule. The idea is simple. Save 25 times your annual expenses and you're financially independent. If you spend $50,000 per year, you need roughly $1.25 million invested. Sounds great on paper. But here's the problem. The 4% rule answers only one question: will the money likely last? It doesn't answer the question most people actually care about. Will you feel secure? Imagine crossing the Atlantic Ocean in a tiny fishing boat. You calculated the fuel perfectly. The weather forecast looks okay. Statistically, you'll probably make it. But are you relaxed? Absolutely not. Every wave feels dangerous. Every storm feels personal. That's exactly how many retirees feel at the traditional 4% threshold. They're probably okay. But they're not comfortable. And that's a huge difference. Now here's where things get interesting. There are actually 3 retirement levels. Level 1 is the survival line. That's the classic 25 times expenses target. The math says you'll probably be fine. But market crashes still feel terrifying. Level 2 is what I call the calm line. That's 30 times your annual expenses. Instead of withdrawing 4%, you're withdrawing closer to 3.3%. A major market crash becomes stressful, but not catastrophic. You have room to breathe. You have options. You sleep better. Level 3 is the indifference line. That's 40 times your annual expenses. At this point, even severe market declines become background noise. Historically, your portfolio often grows faster than you're spending it. The storm is still there. But you're no longer worried about sinking. Now let's talk about the biggest retirement danger nobody likes to discuss. It's called sequence of returns risk. And it has destroyed countless retirement plans. Here's how it works. 2 people retire with identical portfolios. Same savings. Same withdrawals. Same long-term market returns. One retires right before a market crash. The other retires right before a bull market. Years later, one is thriving. The other is struggling. The difference wasn't skill. It was timing. When you're retired, selling investments during a market downturn permanently damages your portfolio. Those shares can never participate in the recovery. That's why the first few years of retirement are often the most important. Research suggests that a huge portion of retirement success is determined by what happens during those early years. That's why having a buffer matters. Cash reserves. Lower withdrawal rates. Extra margin. Those things aren't luxuries. They're protection. And there's one more silent threat most investors overlook. Fees. A 1% annual advisory fee sounds harmless. But over decades, it can cost hundreds of thousands of dollars. In some cases, it can delay retirement by years. The truth is that boring investing often wins. Low-cost index funds. Consistent contributions. Ignoring market noise. That's the strategy that has built more wealth than most people realize. So here's the takeaway. Don't focus only on the minimum retirement number. Focus on the number that lets you sleep at night. The goal isn't just surviving retirement. The goal is enjoying it. Because financial freedom isn't about having enough money to quit working. It's about having enough confidence to stop worrying. If you found this helpful, hit the like button, subscribe to the channel, and share this video with someone who's planning for retirement. And let me know in the comments, which retirement level are you aiming for, survival, calm, or indifference? Thanks for watching, and I'll see you in the next video.